Hello everyone, welcome to today's US Open live webinar. It is Thursday, August 31st, 10 minutes as always before Wall Street opens. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. We're going to talk about the US data dump that included earlier today an uptick in PC inflation, but still in line with expectations and limited market impact so far, and weak jobs data over the previous weeks, and we're again in this period where bad news is good news for Wall Street, since equity markets in the US have been raising despite those soft data points. We're also going to talk about the property sector in China and the poor PMIs as well that we got today. Before, however, we begin, please, as always, read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. We'll give it a few more seconds and we will get the ball rolling. Okay, let's get started. We're gonna start off with Euro USD as always. We're gonna talk about the latest data points and how monetary policy expectations are shifting. We're gonna go to the NASDAQ, and then I want to check out the Hang Seng index, the Hong Kong index, and talk about the latest developments around China and its property sector. And we're gonna then also talk about oil prices, which are also having some significant movement. And as always, we're gonna round things off with what's ahead. So let's dive right into it. As we said, we had a series of soft labor data from the US during the previous day. We're not gonna delve into the details, but we're just gonna say that this showed that the labor market may be coming into better balance, a key goal of the Fed. And we also got preliminary Q2 GDP, which was revised lower to 2.1%, but still higher from the Q1 final. Of course, these soft data points work to the pair's advantage. You can see here this bounce. And we also had today the closely watched PC inflation data. Both headline and core ticked up in July, but we're roughly in line with expectations, and we don't see that much movement around them. In any case, expectations around the Fed, we had talked about how they had been heightened and markets came to pricing another hike, a hockey shift with another hike before the terminal rate has been shifted, but now that has been pared back, and the main scenario for the markets is that rates have peaked, which of course works against the US dollar in favor of the pair. But at the same time, we're seeing paring back in expectations around the ECB as well, which given the economic slowdown in Germany and Eurozone. And of course, we also got preliminary inflation figures from there as well. Core did moderate further, but headline steady, so not particularly helpful for the ECB. In any case, the pair we had talked about how the blue line here, the 200 days EMA, had supported the pair multiple times over the course of the year. We had shown the daily chart. Here it is again. And the 200 days EMA did its job again. The pair found the opportunity to bounce, but cannot follow through, pretty much in line with what we had talked about over the previous sessions. Now, the thing is that given the fact that it stops its 6-week losing streak, there's definitely an upside risk here that it will eventually move above the black line, which is the 200 days EMA, and into the cloud, but still it will need a strong catalyst to be able to push for 1.1096. And of course, we do expect the NFPs tomorrow, so there's definitely more data coming that could be market moving. However, at this stage, the pair is the common currency is in a tough spot. There is still risk for lower lows, although it may be early to talk for steeper losses that would breach 1.0634, 1.0611. Again, we expect more data points ahead that will be crucial for the Fed's next move and could affect the trajectory of the pair. Now let's move to the NASDAQ. As I said earlier, we're again in this bizarre world where bad news is good news and vice versa for Wall Street. The soft labor data that we saw raised expectations that the terminal rate has been reached by the Fed and held NAS 100 higher. It has regained the advantage and the opportunity to set new 2023 highs, which are located at 15,946. But the record ones at the black line that you see on the top of the chart, 16,770, are still distant. Now, with the door open to more hikes though, and more data coming in, there's still risk of renewed pressure back below the 200 period EMA, the black line at around 15,015. But the downside appears well protected, especially this region here between the two Fibonacci level, 38.2% and 50%. Now we're going to talk about the Hang Seng Index. I don't think we've covered it again before, but I want to talk about within the context of the developments in China, which we cover extensively. So what we had today was a continuation of the disappointing stream of economic releases from China, as factory activity contracted for the 5th consecutive month. Manufacturing PMI stayed below the 50 line, which is the threshold for a contraction or an expansion. But on the other hand, this print was marked the third improvement in a row, so there is some hope that maybe it has bottomed and that perhaps the government stimulus efforts are gaining traction. But these are so far, I would say, underwhelming, and markets definitely react to that. We also have the property sector in a rough spot again, and Country Garden, the troubled property developer, posted massive losses today of around $7 billion for the first half, and warned of a default if financial performance continues to deteriorate. So we understand the gravity of the situation. So however, we now see it crosses the wire right before we got into this session about measures to support housing with lower mortgages. So this could actually help. Now, in any case, on the technicals for the HKG33, the Hang Seng Index, we saw a rebound over the past several days and a test of a critical region highlighted by the 200 period EMA and the 38.2% Fibonacci of the last leg down. Successful effort above it would pose the downside momentum, but we'll need a strong catalyst to challenge the 200 days EMA, which is the blue line at around 19,500. However, bears are in control as the aforementioned key resistant area has so far contained this recovery, and there is risk for renewed pressure towards the 2023 lows, although steeper losses that would breach 16,977 have a higher degree of difficulty yet. And of course, the 2023 lows are located at 7,530. So we're also gonna talk about the oil prices and then move into what's ahead. Once again, I apologize. We're having some connectivity issues over these past few days, so we'll try to bring everything back as soon as we can. So let's talk first about what's ahead. The US remains in the spotlight with the August NFPs due tomorrow. The pace of job creation has slowed significantly since the last two prints marked the smallest increases since the December 2020 loss of payrolls. However, unemployment ticked down closer to its 5 decades lows, 3.5%, and wages remain elevated. So the labor market remains tight despite signs of easing, which also highlighted from this week's stats, as we already discussed. So it will be crucial to see the new print. We also expect a series of manufacturing PMIs on Friday from various regions. And the next week actually starts, this goes out with a bang and the NFPs, but the next one starts subdued partly because US markets will be closed on Monday. Things heat up after that though, and on Tuesday the main event is probably the Reserve Bank of Australia, which announces its latest policy decision on Tuesday, and the last one under current governor law. Policymakers have kept the interest rate at 4.1% over the last two meetings, and earlier this week we saw monthly inflation further decelerating, so this will likely allow them to stay on the sidelines again, but we're gonna have to wait and see what they come up with. And things seems to be restored now, so let's go ahead and talk about US oil. Returns to profits after a 2-week correction, helped by the soft US data. Again, this theme that we talked about and how they impact prospects for the Fed. Having defended the 38.2% Fibonacci of the summer rally, it has the ability to set fresh 2023 highs at at 4.91, and it has also formed a golden cross. If we check out the daily chart, a golden cross is when a faster EMA crosses above a slower EMA. As I've said before, I prefer to use the 200 days exponential moving average and the 50 days exponential moving averages. This golden cross is often a precursor of sustained strength. So there is some promise there, but of course we're going to have to see all the data that come in and other factors. And the truth is that at this stage I am a bit cautious about how much further it can go and if it can actually challenge 90.36. Now, we said that US inflation ticked up, and that actually supports the higher for longer narrative by the Fed, and China's recovery is not doing very well. Again, we covered those data points and that narrative as well. So there's definitely risk for renewed pressure, and the RSI, as you can see on the bottom part, has crossed over to overbought territory. So we could see a pullback back below the 200 EMAs at our 200 EMA at around 79.50, and that could pose the upside momentum, but the downside appears well protected. Again, we have here the two Fibonacci levels and a thick rising daily Ichimoku. So that's pretty much it from me. Thank you for joining me, and we will talk again next week on Tuesday at our usual time slot, 10 minutes before Wall Street opens.